Well, thanks everyone. It's good to be here again at Future Proof. It's nice that it's 15 degrees cooler than it was last year. For those of you that were here before, it was miserable in the sweltering heat. So good to be at a normal climate at this session. So today we're going to talk about alternative investments and building this into a diversified portfolio. I think the difference that we're going to take with today's session is going beyond the why and talking about why alts in a portfolio, which has been a lot of really good discussions yesterday at some of the sessions, and I know some of the side conversations as well. And we're going to go right into implementation. So we're going to make an assumption here that you're bought into the idea of alternatives, you want to integrate it into your portfolios, you're kind of going to the next step within your portfolio construction process. And I'm joined today by three very thoughtful people when it comes to making these allocations in an alternatives portfolio. And we've got three very different types of firms as well. So we've got some unique perspectives just based on size of firm, operational setup, so on and so forth. So maybe just a quick introduction of each of my panelists here. I have Anna Snider at Bank of America, Phil Huber at Savant, and then Patrick McGowan from Sanctuary. And each of these individuals are going to walk through a couple of the topics for today's session. So maybe just to start really big picture, and then we'll work our way down into some of these subtopics. I'd love to just start with you, Phil, on just thoughts around, okay, you've gone through the process of convincing yourself, convincing your firm that alternative investments are something you're going to allocate towards. Now there's that whole challenge of actually getting from the academic side of this to the practical implementation side. What are some of the challenges that you face within your firm, and maybe some of the things that you did to mitigate some of those challenges?
Yeah, I think first it's the definition of alternatives. It tells you less about what something is and more about what it isn't. And so I think that leads to a lot of confusion in general because there's so many underlying subcategories that a lot of our advisors, if they're new to the space, they don't really know where to start. And so I think that's really step one. I like to think of it in the framework of, I call it like the 4 E's, which is explore, evaluate, educate, execute. And there's challenges for wealth management firms in each of those areas. By explore, I mean really just like finding ideas, sourcing managers. Evaluate is the deep due diligence that comes along with that. Educate, which is, to me, that's the most important, and not just like educating a firm's advisors, but also them feeling comfortable and confident to translate these inherently more complex asset classes and instruments to their end clients who may have varying degrees of sophistication. And then execute. These, there are obviously a whole assortment of liquid alternatives that trade with ticker symbols and are easy to plug into model portfolios and upload to the custodian. But then you have the whole semi-liquid and illiquid world where you start to deal with, quarterly liquidity or subscription documents and capital calls. And these are a lot of operational procedures that many RIAs are not yet set up to do. There's a lot of great companies out there that are helping make each of these pain points a little bit smoother for RIAs, but there's also still work to do. So I think, there's a variety of implementation issues. But at the end of the day, first step number one is getting the advisors at your firm, conversant and confident so that they're out in the field introducing these to clients, so there's not that mismatch of expectations and that they're not talking over end clients' heads when it comes to jargon. It's kind of like learning a new language a little bit. So yeah.
Great, and there's a lot of topics there that we'll definitely dive into in a little bit. Patrick, I'd love to hear same thoughts from you. As you're trying to develop your platform and get advisors and other professionals in your firm, implemented into some of these strategies, challenges you're seeing, and then ways maybe that you're trying to mitigate those challenges.
Yeah, thank you. And I agree with Phil. So I'm going to try and answer it from my own perspective, which is that the challenge can sometimes be from the perspective of what is the right size, like what is the alternative you're looking at, whether it's a strategy that is sort of like when you think about private markets, sort of like a long only but exposure to assets that are illiquid or originated off market. And how does that compare to an allocation where maybe it's like a divergent trend following strategy or something that will change the portfolio construction, your risk, and when you talk to institutions, they're targeting a vol or they're doing things that like your average advisor isn't necessarily doing. So for us, it's working with the advisors to talk about how whether you're like in an 80, like if you're in a 60-40 portfolio or an 80-20 portfolio, the majority of the risk, the returns you're getting from the risk you're taking are still coming 90% plus from your equities based on your, volatility. So what we're trying to do is get people to implement these things in a portfolio to really think about how it will impact, the returns. So it is a challenge because there isn't really like a one size fits all for everybody.
Great. And Anna, last but not least, you're obviously overseeing a massive platform at B of A. A lot of hoops to jump through, maybe internally, but then a lot of different levels of sophistication with the advisors you're working with, operations, and so on. So I'd love to get your perspective on kind of how your firm navigates this going from point A to point B.
Yeah, so I mean, to pick up on the points, I think the biggest hurdle, right, for advisors is that this is sitting in this weird, alternatives is sitting in this weird asset allocation bucket. You have to like figure out all the different classes of hedge funds, then you have to figure out all the different classes of private markets. Then you have all of this different paperwork and all these characteristics and different structures, and for us, it's no wonder where advisors are just like, listen, I got so much to do during the day with planning and explaining what's going on in the equity markets, let alone the 10-year treasury or something to my clients, that this is like, it's too much to take on. And what I think the way to look at alternatives and the way we want people to look at alternatives is to say, yeah, it's sort of down here because that's the way the industry, smartly or not, I'd say not, has bucketed it. But really, these are different ways to get access to parts of the economy that you cannot get access to in your equity and fixed income portfolio. So private credit used to be the loans that banks, before they put constraints on themselves, gave companies that were growing. Banks no longer did that after the financial crisis. Voila, we've got private credit. So it does make the investment, right, in understanding, right, and sort of just simplifying for your clients and yourselves. Private credit is just another way to get access to a very large and growing part of the economy. Equity long-short hedge funds are just a way to get exposure to the equity markets, but in a way that you can hedge out some of your risk. Private equity, venture capital, growth capital is, if you're not investing in it, you're literally not investing in innovation, right? And that probably, like with the IPO markets and the equity markets like they are, and everything sort of being taken over by M&A in the transactions that are happening, the investment is worth it. And I know it's hard. That's the hardest thing that we have to get over with advisors, because we'll talk about some of the structural and some of the impediments. But if you are not doing alternative investments, you are not investing in huge parts of the innovation and growth in the economy. And that's sort of the way we start out with both clients and, of course, our advisors as they talk to clients.
And Anna, maybe just to follow up on that internal education for the advisors and making this a little bit more relatable for them, I think is an important point, because I think wrongly, as you said, we've kind of taken this big umbrella term of alternatives and kind of thrown it over in the corner, and it's esoteric and it's weird. And
now there's AI, which is not AI anymore, and that's confusing.
Although there's AI hedge funds, that's AI squared.
Yeah.
So we can trademark that after the session. But I think just sticking with the internal education, could you talk a little bit about some of the things that you guys do internally, maybe a little bit more tangibly, of educating those advisors to maybe demystify the alts experience, because then they can in turn educate their clients and help them be bought in that process.
Yes, I mean, one thing we do anytime we approve a new fund in the alts world, we'll immediately before we even start implementing, we'll do an educational campaign. We'll get the manager to come do a webinar for our advisory team that's scattered across 13 states, and just try to get that up front so that we're not essentially we'll do a pause after we approve something. There'll be a little bit of a lag between us actually implementing because we don't want to just like make the decision, start trading the portfolios, and then they're getting inbound calls and emails like, hey, what's this new fund? And they have no idea how to explain it. What we've also done too is created like little, we call them like baseball cards, kind of one-pagers for each alternative category we use that, essentially is showing, when should this be expected to do well? When should it be expected to do poorly? What is the source of the risk premium? And why should you expect to make money in this over time? What are the historical correlation, risk-return benefits, and a little bit of information on the fund that we're using. And it's just a nice one-pager that they can share with the end client that we try to make as plain language as possible. And I think those have been really helpful so that they don't feel the need to like over-explain. Because if you start over-explaining the alternatives, but like that's when you lose the conversation, because then it gets too technical, too in the weeds, and you're kind of missing the forest for the trees in terms of what is the purpose of this investment inside of your portfolio, both on a standalone basis as well as complementary to the rest of what you own.
Patrick, Anna, any other things you'd add?
The base card, I might steal that idea. That's kind of
tokenized?
Cool.
Is it a tokenized baseball
it's an
card?
NFT. I think we try to go the traditional route by, education through webinars and roadshows, things like that. And I thought that when some of the new strategies, and a lot of those strategies are here today, when we come across them, there are so many good managers that are coming to this space and making their strategies available. A lot of the times, not always, that's our job, is to discern which one is as good as an institutional fund and when is it is and when is it isn't, because there's a lot of stuff. But you would think when they hear about it and see about it, they would implement it, and they don't right away. And, I have sort of like a core group of 10% of our firm that can do meaningful amount. And then the question is, why isn't everybody else doing it? And even for me, it requires having a meeting, having a call, directly with the team. And usually our teams are, around $1 billion in size, and they can do significant amount of allocations. But understanding their business, and everyone has their own, they need to feel really comfortable about like why we even went about approving that and what the opportunity set is. So it's just like it's hand to hand. It's combat. Yeah.
Combat.
Yeah, I would say the way that we approach it, like before we get to the product level, is that we have a bit of a framework that talks about, well, what is the intended outcome for this solution in your, right? Because all these managers will come to you and they'll be like, and I have this great thing and I do private equity and then I do this, this, and this. And you're like, okay, wait, what is this supposed to, where do I put this in my portfolio and what is it supposed to do for me, right? So is it alpha generating, right? Am I supposed to get a premium over the public markets, right? And you should always say to a manager, show me how you've gotten the premium over the public markets, right? And then make sure you look at their valuation methodology. You can have something that's diversifying or hedging out risk, right? So for instance, global macro hedge funds in 22, basically the only type of investment strategies that was up, right? And then they're down for years. To be right, they're a hedge. They're sometimes an insurance against volatility, or they can take advantage of other markets outside of fixed income and equity. And of course, then you have just plain, risk mitigators, right? Things that are supposed to smooth the ride. And before you look at any and across real assets and hedge and private markets, you've got strategies that fit into any one of those three categories, right? Alpha, diversifying, hedging, risk. And you really should know, because every client wants to know, okay, well, what is this going to do for my portfolio, right? And I'm sure that all of you don't have complete back testing. Well, I don't think FINRA allows you to have anymore complete, back testing tools that allow you to plug in something and then back test a whole portfolio and show clients what it's going to do. So, to me, the most critical thing is, again, simplifying what these things are, what kind of market you're trying to get exposure to, and what's it supposed to do in the portfolio, and then everything should fall in. Then there's a lot of due diligence, and there's operational stuff, and there's documentation that will go. But But all of that is just then a set of things that you need to do to make sure like that's the right product in that category for you, rather than trying to sift through like an entire list and say like, how do I begin to differentiate? So that is how you begin to really differentiate in the alternative investment space, right? And if a manager cannot answer that simple question, just move on. If your wholesaler has no idea what the what the use is in a portfolio and what the outcome is, move on. That's my advice to you.
Anna, maybe sticking with you because you oversee both traditional and alternatives. Let's just assume that we move to a place where we're not actually differentiating those as we have been. Could you just talk about the difference in approach from maybe a due diligence perspective, things that people should be considering when they look at, and maybe within that, let's differentiate hedge funds and private markets. What are some of those big differences that you're looking at on the alt side versus maybe a traditional long-only stock or bond, fund?
Yeah, I mean, it's not as different as people would have you think. But really the major differences are the ability to get liquidity when you want it, and I always argue like for most clients, even clients that don't have a lot of money, like a 2% allocation, a 5% allocation that's illiquid is not going to their cash needs. Like if you're doing your jobs well, which I assume you do, their cash needs will likely be met by the 95% of the portfolio that's not illiquid. So, but liquidity, leverage, and a lot of those have to do with structure and operational risk, which is a lot different in alternatives than it is in SEC overseen mutual funds, ETFs, et cetera.
And Patrick, maybe sticking on the subject of illiquidity, because I think that's an uncomfortable feeling for a lot of clients, maybe for a lot of advisors as well. How do you talk through the concept of illiquidity, and maybe are there ways that you show more tangibly how illiquidity plays into a portfolio or an asset allocation that includes a spectrum of liquidity?
Yeah, I think that's one area that is really lacking in the, I guess, wealth management space in general, which is that if you're an endowment, you have an idea exactly of what your asset and liability, what your a lot of times they have a lot longer time horizons, hundreds of years at least, but they think about it and they know what their liquidity needs are. In the financial services world, and I've sort of tested this internally, but there's no real way because there are all these new funds with new wrappers, and not even new, but a lot of newer funds are coming out with this liquidity and mechanisms, which is great, but the advisors still don't really track. This account is drawing 20% of its money per year. I mean, I think they have. If a lot of our advisors looked at the amount across on aggregate, how much they're drawing, particularly in things like fixed income or things that are like these kind of like bellwether buckets, I would imagine it's going to be like in the single digits. Like the amount of, now it doesn't mean you may not need access to it, but as of now, there's no real, it would be great. I'd love for people to walk in and do a portfolio looking at like a dashboard and going, okay, you've basically, your client tells you they may want this much liquidity, but they literally haven't touched their portfolio in 10 years. Like, you might as well think about having that conversation. So I think it's not front and center in the advisor's mind because it's also not something that they've even necessarily considered until they've thought about, this concept.
Phil, maybe, and we'll come back to fund structures. I want to spend some time on that. But Phil, maybe just to round out the liquidity conversation that you're having, and I know you do a lot in liquid alts, maybe dabble a little bit in some of the semi-liquid.
We do a fair amount of the semi-liquid, and less so the true private. Like I think every advisory firm, like your journey in alternatives is going to be a function of the size and resources of your organization, and also what your kind of typical client profile looks like. Some firms might work, with QPs on the higher end of the, high net worth spectrum. Others more accredited, others non-accredited. So I think that's going to help define and shape what types of asset classes and fund structures that you explore. But I think what we're seeing in general is just a really rapid growth of the semi-liquid universe, which really there's kind of four, buckets there. It's interval funds, tender offer funds, private REITs, private BDCs. Each works well for different asset classes in a better way. And I think what's appealing about a lot of those is just the convenience features that a lot of advisors and their end clients appreciate. Lower minimums, more immediate diversification, 1099 versus K1 for tax reporting. In the case of interval funds, like a ticker symbol. So I think that end user experience is helpful, but it's also important to remember when you're holding illiquid assets inside of a semi-liquid structure, there is a degree of a illiquidity mismatch. That's why those quarterly windows have potential gates that can go up, because you never want to have a fund in a position to be fire sailing assets, at the wrong time. And so I think it's just important to really set expectations properly with clients, like especially in the case of interval funds, because they do look and feel and smell just like a mutual fund. Outside of that liquidity piece, it becomes a little easy to just gloss over some of the finer nuance and detail around gates, et cetera. But that's a feature, not a bug. And I think it really those and these other types of fund structures open up a plethora of different asset classes and exposures that otherwise advisors wouldn't have access to. In the case of private equity, for example, though, there's trade-offs. Like you're probably going to be more focused in secondaries and co-invest inside of those, and just for that more immediate diversification and kind of shorter time to exit. And so it's going to have a different return profile than if you were just investing directly in a primary PE fund. But I think, again, because of the nature of some of these, particularly in PE and venture, where you have this huge dispersion of returns between top and bottom quartile, it's a very challenging exercise for even fairly wealthy investors to build a bottom-up diversified allocation to these private market classes. So I think having these, commingled vehicles where you get that, in kind of one-stop shop, I think can be really beneficial. But it's important to really understand the nuance with these different structures.
Anna, so on the topic of fund structure, and I've heard it in presentations before, and name your GP. They kind of make the comment, we're investing the exact same way. We're just offering different wrappers that are available across liquidity spectrum. I'm assuming you have a view on that, so park that for a second. But I'd love to hear just how you look at a GP. Let's pick private credit, for example, or even private equity. And do you look at those differently based on the wrapper, or are you looking more at the strategy as a whole and then just kind of assessing the wrapper's appropriateness, for approval?
Yeah, assessing a single strategy, like just call it like a drawdown growth fund or drawdown buyout fund, it's not necessarily easy. I mean, you have to understand whether you think that the manager has a number of different, they can source, they can actually operate a company, they can exit, yada, yada, right, if they've been successful. But that's where that ends. When you put things in one of these wrappers, a lot of times there's an allocation component. So they're allocating between secondaries, as Phil said, secondaries, primaries, and co-investments. They're allocating sometimes across large areas of the private market spectrum, or even large parts of the private, say, equity or the private credit spectrum. And so you have to actually understand their expertise sort of in actually allocating across markets, right? So now you've got a different layer of understanding, okay, well, are they good asset allocators within this sort of asset class, as well as good selectors of company and operators of companies? And then do they have the right ability to understand what we refer to as the asset liability, or we all refer to in the industry as the asset liability mismatch, which is inherent in these products, right? Which is to say, well, do they have the right scenario? Do they understand what they're going to do when SVB happens, right? Or when 08 happens, or when their part of the market dries up, right? In terms of being able to exit opportunities, and so it is actually, I think, a harder, and then there's all the operational risk considerations that you have to go through. So And to be honest, there is, and this was mentioned, there is often there is a trade-off in these because you have in many of these structures thousands and thousands and thousands of line items versus a portfolio of 30, diligence for like year, active board, majority ownership seats. It's a different return profile that you have, but it's still, we think it's still accretive, right? It still will give you a return over the public markets. It may just not be the QP structure type of return because that is just more concentrated, right? And you should get a higher return for that level of concentration risk and that level of liquidity. And, it just goes down the risk and return spectrum from there. But it is, I think, a more complex. But do you want me to give my opinion about
Yes, okay. I do.
So there's a game. So just be clear that there's a game being played, right, between the cash you have to keep on hand, the leverage that you apply to the portfolio, and in private credit and private real estate perpetually offered funds, the yield that they're looking for. And we all know that there's no such thing as a free lunch in any of those regards, but I will say this, invest in these are good firms that have thought through a lot of this stuff, right? And I think their valuation is fine. Of course, there's been a lot of stuff in the media around valuation, and we've looked at a lot of these firms, not every single one of them, so I can't overgeneralize, but the ones we have on our platform we think are being good in terms of valuation. But they are, right, they know that what these are being bought for is yield, right? And so the yield and the distribution is what they are trying to make sure that they are leveling off. And there are a lot of levers to play with to get there. So just make sure, right? And at some point, maybe not, I was surprised that not after SVB, but at some point, these things are going to be liquid. And your clients are going to freak out. And what you say to them is, no, we want this to be illiquid right now because it means that they're trying to preserve the performance in the portfolio. You do not want them to sell, right? And that's the big difference with, say, a fixed income and a private credit fund. So there you have it.
Yeah, I would just say, too, a gate going up on a fund, be it interval fund or otherwise, is not a kiss of death for the fund. It actually can work out well. Every asset class is going to go through periods of underperformance and challenges, and I think those test the wherewithal of a lot of allocators that thought they were in it for the long term and then get spooked out and they want to exit all at the same time. The gate goes up. It's probably unpleasant for people that want their money back and can't get it all at once. That's understandable. But for those that want to remain in the asset class and like the long-term exposure, there's been good examples. Obviously, not going to and can't name names, but ones that have come out of that, the gates go back down, and then they go on to have their best year of performance. And those that had the discipline benefited from that. And so, again, it's very much a feature, not a bug, of those types of wrappers.
I would, when you look at all these, and, I think when you look at all these managers, I think Anna brought this point up that a lot of them are really good that come to us and say, we know this manager, we look at the track record of every vintage of their their entire platform, whether it's credit or private equity or real estate or whatever. And what we look for that's table stakes is if you look at, let's say that the Evergreen Tender Offer Fund started today, and then it started the same time as their Vintage 9 fund. Well, deal A, B, C, and D in Vintage 9 better be in that fund. And then when 10 comes out, deal, E, F, G better be in the fund. So what you get, ideally, is this fund that has all the same deals. The problem that was also brought up was the same way the average retail investor is pretty bad at investing in drawdown funds is because they don't know how to manage the cash and the capital. Your average advisor isn't doing overcommitments and strategies and modeling cash flows. Your average institution is at over 100% of commitments, by far, depending upon what the strategy is. So the question is, how good is that manager at portfolio management of an evergreen strategy, and what's their track record? A lot of them don't have one, which is fine. But do they have a dedicated portfolio manager, somebody that's in charge of risk? What is their cash and what's their leverage use? And so a lot of it, you'll see the dispersion of the returns of these managers is becoming more evident because, aside from the valuation part that we brought up, but like some have really good fixed lines of credit that they're not getting, that they're benefiting from right now, and some had big lines of credit that are 8-9% right now, and you're seeing the NAV erode every single day, and there's nothing they can do about it. And you're just watching these products, and you're like, I can tell who's doing well and who's not going to do well. And they have great deals in the fund, but structurally, and they're fine. And it's just like, how good is this manager at running one of these funds?
So Patrick, you bring up a good point on the actual management in the portfolio of cash, and these aren't unless you're buying an interval fund, for example, you might be able to point and click. But if you're doing traditional drawdown fund or even some of the semi-liquid structures, how are you actually managing that cash flow within your firms to kind of streamline that process and then make advisors comfortable with that kind of liquidity profile at the actual firm level, managing that process?
As far as like subscriptions go? Well, from our perspective, a lot of our advisors open up entirely new accounts separate from their other accounts, so they don't commingle their alternatives in with their traditional assets. And it's certainly a challenge. A lot of probably half of a lot of the work that we do is dealing with subscriptions that are weird, wires that went missing or whatever, and you try to, while I think the more institutional like in the fund, the better. At the end of the day, sometimes these funds that are ticker based are certainly easier from a home office perspective, operational perspective. So,
Anna, I don't know how involved you get with the cash management. Phil, thoughts?
That's all back. I have no idea how it works.
Since we're mainly liquid and semi-liquid, and a lot of the semi-liquid is interval-based, it is. There is a learning curve when we started to add some subscription-based products to our platform. Like we had to really kind of train our CSRs on how to go through that process on the alternative platform portal and just kind of manage that workflow. And so it forced us to create internal processes and mechanisms through our CRM, et cetera. The ops team's involved, so it definitely. It takes a village sort of thing. Like it's not just the research team like approving it and putting it out there. Like we got to meet with all different parts of the organization and make sure it ends up being a smooth client experience, because that can take what otherwise would be a great investment and something they should be excited about in their portfolio. And if it's bad ops experience, then they're going to get angry and want you to get rid of it. So
yeah, we just say like Jacksonville, and I think there's like hundreds of people in Jacksonville in our thing that like take care of this. So.
Fair enough. We've got some questions here in the last couple minutes, so maybe I can direct this to whoever wants to grab it. The first question is, what are some of the biggest mistakes you see in building an alternatives allocation?
I'd say probably the two is just like putting things in to have a line item and like check a box, but it's like a 1-2-3% allocation. That doesn't move the needle. So I think it's important to, you're going to go into alts, and it doesn't have to be for each fund, but like in aggregate, it has to be a meaningful portion of the portfolio to make an impact, but not so heavy that it's going to create an uncomfortable client experience where half their portfolios and things that they are not used to owning. And I would say the other, and this is maybe more relevant to sort of the liquid side, but just using things tactically as opposed to strategically. Look at the flows of like managed futures fund. Like when does all the money come in? It comes in after 2022 and after 2008.
The timing's not perfect?
No, it's the inverse of perfect. And so I think it's just like really understand like there is not a single, like there's a reason we have an assortment of alternatives in our portfolios, because there's no individual one fund or asset class that is going to check every single box and be this like silver bullet. They all have flaws. It doesn't mean they're not worthwhile holding, but they require a long time horizon. You got to understand there might be some long winters involved where you got to, be defending it in a client meeting. And so, but I think it's like really think about it strategically and not try to time these things, because I think as we're all aware, timing equity and bond markets is hard. The same goes for any alternatives as well. So
And I know you were jumping, but Phil beat you to the punch. Any thoughts you'd add?
No, I just would say alternatives should be bought, not. I mean, should be, bought, not sold. They're not deals, right? I see this these perfect asset allocations across the public markets with advisors, and then it's like, give me that and that and that, like with alts, and you're like, no, you're building a long-term allocation, and they're still sold in this industry as deals. They shouldn't be. That's a big mistake.
Great.
Yeah, and I think one of the educational but also issues that isn't as well designed in private markets yet on the retail side, I think on the institutional side it's sort of there, is people will be like, oh, I have a BDC, like I'm good. And you're like, okay, well, when you look at the construction of a traditional portfolio, if we start with, all right, let's just start with the Barclay, with the fixed income benchmark. So it's got some, it's got the ag, so you've got some treasuries, and you've got some MBS, and you've got some credit. And then you're like, okay, well, if I overweight this, we can increase duration, we can short duration, increase quality. And advisors know when they're going to do that, how it's going to impact the portfolio. Well, if I add that BDC in particular, what does that look like? Well, no one's like, I mean, we are, but not the average advisor isn't going, well, a lot of these are first lien, so I'm going to treat this maybe as if it's going to draw down I'm going to take a little less credit or more credit exposure, or how does real estate credit differ in terms of, the four quadrants of GDP increasing, decreasing, or inflation increasing, decreasing, how do these buckets and quadrants work? And some consultants do a great job of showing how you can invest in these different cycles on the private markets, but the advisors just aren't quite there yet, because you should be able to invest in a bunch of things and have an idea of how that portfolio is going to react depending upon what's going on in the market. But I think advisors are just like, oh yeah, I've got a BDC, I think I'm all, or they're over allocated. Usually, institutional versus retail. Retail's way more into real estate than your average institution, which is way more into private equity. So you just see these observations that I'm making that you just see.
Great, and we've got a ton of questions that we won't get to, but maybe one final question, then we'll go to final comments. And Patrick, can I start with you on this? Is taxes and just the discussion around, again, maybe this is the fund vehicle discussion or in general, but how do you talk about taxes with advisors and clients on alts?
Unfortunately, high income strategies tend to go into retirement accounts, and then you put your private equity or secondary stuff maybe into your taxable accounts. But we're looking at tax aware strategies, things that help long short managers that are there to capture and be able to pass along tax. Tax itself is becoming its own asset class and strategy, which some of our smarter teams are doing. I don't know if you guys are looking at that stuff too.
Yeah.
Can't really get around it.
Yeah, I mean, it's obviously a client by client type of thing, but yeah, I mean, the hedge funds are highly not tax, or they're highly bad for taxes, but there are ways now to start overlaying them. I wouldn't bet that the rules don't change in private equity in terms of how people, taxation gets handled, and so, but you have to think that it's the after tax, right, is actually worth it, and you have to figure that into your due diligence and your sort of return assumptions. So that's how we try to handle that way.
I got nothing to add there that they didn't say, but
Fair enough.
The IDF space might grow a lot. I see a lot of hedge funds and IDFs in those structures are going to be, at some point they'll catch on. They've caught on a lot, but.
So maybe in the final minute here, just kind of anything that we haven't talked about or any takeaways for the audience when it comes to implementation of alts. Anna, can I start with you and we'll just work our way towards me?
No, can I just take that question, the best idea
Yeah,
that's
I
not
like
private
that question
equity or
too.
private
We all do
credit,
that?
because it'll take 2 seconds. The largest pumping of money into infrastructure in anyone's lifetime is taking place right now. Look at infrastructure. Just the tailwind is ridiculous, and I hate the word tailwind, so that's a thing.
I would say two ideas. One is catastrophe reinsurance. That is an asset class that went through a number of really challenging years. But the flip side of that is that now because of the supply-demand imbalance, you have the highest yields there. They've been in like probably 30 years, and so that's one. And then I would say, just as I look ahead the next 3 to 5 years, I think venture capital is an asset class that RIAs should start to pay attention to. It's notoriously, historically, been a very, very tough nut to crack for RIAs, particularly when it comes to accessing some of the top, GPs out there. Which, if you're going to have a successful venture experience, you need, access to those top managers. That it was very hard to do. I think it's going to become easier and easier to do with some of the really innovative platforms out there that are trying to solve that asset class for RIAs. So, and we're now in a much more sober, I think, valuation environment relative to a couple of years ago. So that's one area I'm a little excited about.
Patrick, real quick.
Those both are great. I was leaning infrastructure, but I would say just secondaries, just because of the discounts at this moment in time, which kind of is credit and equity.
Right, and because pension funds are dumping their portfolios for cheap.
All right, well, with that, we're going to wrap up. Please join me in thanking our panelists for a great discussion.